here from Creativo Solutions. You're currently watching the Accounting for Non-Accountants video series. Feel free to post any comments or questions below and consider subscribing so you'll be the first to find out when new videos are uploaded. Visit our website for more content and resources to help you. Consider following us on Instagram and Twitter, and keep watching the YouTube channel for more support. We've looked at the accounting rules and you should be comfortable applying them by now. We know that the rules are universal and they don't change. There are 6 accounting elements that can always be applied to all transactions. We know accounting is a skill that needs to be practiced in order to master the application. We're always going to keep it simple. That's the approach that I'm taking, and I'm going to be utilizing the basic principles covering the different rules, such as assets, liabilities, income and expenses, and capital and drawings. We're going to then apply what we know to different scenarios. We need to recap what a transaction is. We know transactions are proof that there has been an exchange of goods or services. So when focusing on a transaction, we're looking at the buyer and the seller. The buyers and sellers are going to be engaging in different transactions whereby the business will either be buying or selling, and that's going to create a transaction that needs to be recorded in the books of the business. Companies need to interpret those transactions. So we as the accountant or the financial manager needs to understand what each of the transactions entail, because then we're going to know how to record that information and create information in order to make decisions. We know accounting is all about making decisions and choosing which plan is the best option. In order to decide, we need information, and that's the purpose of accounting. We know the double entry rule is applicable when dealing with transactions. There will always be a debit and a credit. So when analyzing and interpreting transactions, we know that certain transactions are going to have an effect on certain accounts. In this example, which we've covered in a previous video, we're looking at capital contributions made by the owner. If the owner is giving $1 million to the business, we're then focusing on the owner as being the individual that's creating this transaction, where the business is receiving money directly from the owner. In this scenario, we know bank will be affected positively because the business is getting $1 million from the owner. So the bank account of the business, we always look at the perspective from the business's point of view. The business's bank account will be increasing. We know bank is an asset. Why is bank an asset? Well, bank is a resource we control that gives rise to future economic benefits, and therefore it meets the definition of an asset, and we would then classify it as an asset that's increasing, and therefore we're going to record that amount on the debit side according to the rules. Why did the bank increase? Well, the owner contributed $1 million. So that would be seen as a capital contribution. C for capital, C for credit. Capital account will have $1 million sitting on the credit side. Here's another example where we're looking at receiving income. Again, we've covered these concepts before in the previous videos. We're just recapping some important points that you need to understand in order to look at the recording, which is going to be focusing on journals. If I'm focusing on the double entry, here I've got an example where cash is received from sales of $3 million. So the cash sales represent an amount that's going to be affecting the bank because I'm receiving cash. So bank is an asset. If I'm receiving cash, it is increasing, and therefore assets increase on the debit side. So the bank account will have $3 million recorded on the debit side. Then we've got the sales side of the transaction. What's happening? Well, we're making a sale. Did we have a sale before? No, we now have a sale. So the sale has actually increased. So we now have more sales than we did before. Sales is what type of account? Well, it meets the definition of income. If sale is an income and it's increasing, it'll therefore be credited. So now we know what the debits and credits are. bank will be debited and sales will be credited when looking at this transaction. So by now you should be comfortable interpreting and analyzing different transactions according to the accounting elements. We need to apply those rules in all areas of accounting. The better we know our rules and the easier it is for us to interpret what's happening in the transaction, the better accounting will be going forward. So when focusing on a journal, we've discussed journals briefly when we spoke about the accounting process, and we know the accounting process is obviously broken down into different steps whereby we're trying to create those financial statements. So to summarize what the journal is, a journal is just a way to group transactions into different categories. Journals are like classification boxes where we're taking transactions that are similar and we're going to putting them into one journal or book in order to make the accounting more simple, to then generate totals and to transfer those amounts through to the ledger. So when focusing on transactions, they can be grouped into categories. I've given one example here of a journal called the cash receipts journal. If I'm looking at cash receipts, well, now I'm thinking about all the receipts that the business will be getting. So we just looked at two examples. The business received money from the owner, that was capital, and the business also received money from sales. So we've got two different scenarios that are both affecting the bank. So the cash receipts journal could record all of those similar transactions. The two transactions we just saw in the previous slides was covering bank as an asset increasing. So if bank is an asset and it's increasing, both transactions are affecting bank positively. So both of those transactions can be recorded in a cash receipts journal. In a cash receipts journal, we're going to be affecting bank positively always, and will be affecting another account. It could be income, it could be capital, or it could be anything else that would have a direct impact on bank in a positive or favorable way. Grouping all our cash payments, and the journal here would be the cash payments journal. Cash payments represent a decrease against the bank account. So any transaction that's going to affect the bank negatively is going to be recorded in the cash payments journal, because bank will be decreasing in all those transactions. If I buy stationery for the business, bank will be affected negatively so long as I'm using cash. If I'm going to be paying off a liability, I'm going to be using cash in order to do that. So bank will also be affected negatively. Maybe I'm paying the owner for the drawings that they've taken. So in that scenario, bank will also be affected negatively. We know that there are many transactions. Businesses don't only have one or two or three transactions. They'll probably have several, hundreds or thousands or millions of transactions, depending on how large the business is. So when focusing on journals, we're looking at recording similar transactions into a particular group, whereby we can use the information that's summarized in order to transfer totals through to the general ledger. When looking at the cash payments journal, we know bank will always be negatively affected. Asset will decrease on the credit side, and the other account, be it an expense or an asset or a liability or anything else, would then be debited in this particular journal. To summarize, in this video, we've now introduced the concept of a journal. The journal is a very easy, basic accounting book to remember in terms of the recording of transactions. In today's world, everything is electronic, so all of these transactions can be captured on a computerized system. We know transactions will relate to the buyers and sellers. Those buyers and sellers will have source documents. When I purchase something from the store, I'm going to get a till slip or an invoice or a receipt, depending on what I'm actually doing as a transaction in that particular scenario. Transactions are recorded on source documents, and the journals are going to be recording all the same transactions in a particular book whereby we can summarize the information in order to make good decisions. So transactions are recorded on source documents. Source documents act as the proof or the evidence that a transaction has occurred, and that is recorded in a journal. Then we also have ledgers as well, which forms part of the accounting process. We're not going to be going in too much detail with the ledger. A ledger is just a list of accounts. We're going to be focusing specifically on the journal. So journals are going to be used to group transactions. They total up different accounts that are affected in a particular transaction and can then be transferred to the general ledger. Bookkeeper is actually capturing the data that has been collected from all the transactions that have occurred in the business. That takes us to the end of this video. Thank you for watching, and please consider subscribing to the channel, post any comments or questions below, and consider liking the video, and we'll keep creating more to help you.